Have investors completely forgotten about PayPal? While everyone is focused on AI giants like Nvidia, Microsoft, and AMD, PayPal may be quietly setting up for a major comeback. Today, we're taking a deep dive into PayPal stock, ticker symbol PYPL, to see whether this beaten-down fintech giant could be one of the market's most overlooked opportunities. Let's start with the chart. PayPal is currently trading around $41.50 per share, which is far below its all-time highs reached during the pandemic boom. Over the last couple of years, the stock has been stuck in a long-term downtrend as growth slowed and competition intensified. However, the chart is now showing signs of stabilization. The stock appears to be building support in the $40 to $42 range, which could become an important foundation for a future recovery. According to analysts, the average 12-month price target is approximately $47.72, representing nearly 15% upside from current levels. More bullish analysts see the stock reaching as high as $63, which would imply over 50% upside potential. Now let's talk about what's driving the bullish case. One of the biggest developments is PayPal's aggressive push into artificial intelligence. The company is investing heavily in AI-powered commerce tools, smarter checkout experiences, and automated payment solutions. Management believes AI can improve conversion rates for merchants while creating a better experience for consumers. As AI continues transforming digital commerce, PayPal wants to position itself as a key player rather than getting left behind. Another major growth catalyst is Venmo. Once viewed primarily as a peer-to-peer payment app, Venmo is becoming a serious revenue generator. Recent reports show double-digit growth in payment volume, and the platform continues expanding its monetization opportunities through merchant payments, debit cards, and business services. If Venmo continues growing at its current pace, it could become one of PayPal's most valuable assets over the next several years. The company's recent earnings results also surprised Wall Street. Revenue growth exceeded expectations, payment volume continued to rise, and earnings per share came in stronger than analysts anticipated. While PayPal is no longer the hyper-growth company it once was, the business is still generating billions of dollars in revenue and significant free cash flow. Another reason investors are paying attention is management's restructuring effort. The company has launched a major cost-cutting and efficiency program designed to improve profitability and streamline operations. If management successfully executes this plan, PayPal could significantly expand margins and boost earnings growth over the next few years. However, there are still risks investors should understand. Competition remains fierce. Companies like Apple Pay, Stripe, Block, Klarna, and Affirm continue fighting for market share across the digital payments industry. In addition, PayPal's traditional checkout business has experienced slower growth, which is one of the reasons the stock has struggled in recent years. Investors will need to see evidence that the company's new initiatives can offset these challenges. So, what's the investment thesis? The bull case is straightforward. If AI initiatives gain traction, Venmo continues growing, and management successfully executes its turnaround strategy, PayPal could re-rate significantly higher. Under that scenario, a move back into the $60 to $70 range over the next couple of years is not impossible. The base case scenario suggests moderate revenue growth, improving margins, and gradual investor confidence returning to the stock. In that situation, PayPal could reasonably trade between $50 and $55 within the next 12 to 18 months. The bear case is that competition continues to intensify, growth remains sluggish, and investors lose patience with the turnaround story. If that happens, shares could fall toward the low to mid $30 range. Overall, PayPal looks less like a high-risk growth stock and more like a turnaround value opportunity. The company still has a globally recognized brand, a massive user base, strong cash generation, and multiple catalysts that could unlock value over time. While it may not deliver Nvidia-style gains overnight, patient investors could be looking at one of the most overlooked opportunities in the fintech sector today. So what do you think? Is PayPal a value trap, or is Wall Street underestimating the company's AI-driven comeback potential? Let me know in the comments below. If you enjoyed this analysis, don't forget to like the video, subscribe to the channel, and turn on notifications so you never miss the next stock breakdown. Thanks for watching, and I'll see you in the next video.